Welcome back to the Pro Ticker Podcast, your Tuesday morning edition covering major financial magazine headlines, everyone. You're joining us for a deep dive today. We're going behind those headlines, really digging in. We've sifted through a whole stack of reporting, Bloomberg, MarketWatch, the Wall Street Journal, all pointing to some, well, really interesting cross currents in the markets right now. We're going to unpack what's going on with the dollar, the pressure on big tech, tariffs, their impact seems huge, and, how global markets are reacting. Our goal, give you a clearer view of how all this fits together, what you really need to focus on.
Absolutely. It definitely feels like we're at maybe an inflection point. Lots of established trends seem challenged. You've got policy, geopolitical stuff. It's all feeding into the market in a big way. We want to connect those dots for you beyond just the headlines so you get the bigger picture.
Okay, let's jump in. Starting with the U.S. dollar, Bloomberg had this piece. Bearish dollar bets move toward levels that raise risk of recoil. It mentions the dollar's hit its lowest point since, December last year?
That's right. Lowest since December 2023.
So what's driving that dip? And is this rebound idea real?
Well, the Bloomberg article flags a couple of key things putting pressure on the dollar. First, you got the noise around former President Trump potentially wanting to fire Fed Chair Powell.
Right. That always creates jitters.
Exactly. It throws Fed independence into question, monetary policy direction. Investors just don't like that kind of uncertainty about dollar assets. Then there's this growing worry about the U.S. economy maybe slowing down. Recession risks. That's fueling what they're calling a sell America trade, people backing off U.S. assets.
Sell America.
Wow, that's a
Strong phrase. But, like the article suggests, maybe everyone's piled onto that trade. This is where it gets interesting. Technicals. They mention the RSI for Bloomberg's Dollar Spot Index. For listeners, RSI, Relative Strength Index. It basically signals if something's moved too far too fast, right?
Precisely. And right now, it's screaming oversold. Lowest since 2020, actually. And they point out a similar reading back in July 2023. That came just before a pretty decent 7% dollar rally.
So history suggests a bounce could be coming.
It suggests the potential for one, yeah. When sentiment gets this extreme, Ken Chung from Mizuho Bank, quoted in the piece, he thinks the dollar is poised for a rebound, short-lived or not. He points to those huge bearish bets, like you said, maybe too crowded.
Yeah, the article mentioned $40 billion in net bearish positions.
Yeah.
Most since October. That's a lot of people betting against it.
Exactly. And Chung also mentions the technicals we talked about, plus the yield advantage the dollar still has, even after inflation.
Okay, so yield's still a factor.
Definitely.
Yeah.
But when everyone's on one side of the boat, Christopher Wong at Overseas Chinese Banking Corp, he warns about this big consensus trade of shorting the dollar. The risk, a short covering rally. If everyone who bet against it suddenly needs to buy dollars back.
They could push the price up fast, squeeze out the remaining shorts. Makes sense.
And it's not just technicals or positioning. The Bloomberg report found some fundamentals too. Like foreign central banks actually increased their holdings of U.S. treasuries recently by over $10 billion in 2 weeks in April.
So they aren't exactly dumping dollars then.
Doesn't look like it, no. And again, that inflation-adjusted yield premium over other currencies is still there.
Yet, the article notes the dollar struggled to hold gains yesterday, even after initially rising. What's that tell us?
It tells us the negative sentiment is really strong right now. It's sticky. So yeah, maybe a technical bounce is possible, maybe short covering. But those bigger worries about U.S. policy, the economy, they're still weighing heavily. It's a real tug of war.
Okay, let's pivot to big tech. Another Bloomberg piece. Big tech dip buyers vanish in options market with earnings ahead. Sounds like that classic buy-the-dip strategy for tech might be fading.
That's what the options market seems to be suggesting, according to this article. What they're seeing is traders buying way more put options that's the right to sell compared to call options, the right to buy.
Puts for protection, calls for upside bets. So more people are hedging downside.
Exactly. They're looking for protection against prices falling further. Less optimism about gains. This call-to-put ratio, it's near its lowest point since late 2023. That's a clear signal of caution, especially with earnings coming up.
So instead of rushing in on dips, investors are like, whoa, let's maybe get some insurance first.
Pretty much. And Monday's broader market slide didn't help. Those trade worries, the Fed chair talk, it adds to the caution.
Yeah, the article quotes J.J. Kinahan from Tasty Trade saying investors want to make sure they're not caught in case we continue downward.
Makes sense. There's this general unease, right, about global trade possibly realigning, plus questions about whether tech valuations got too high after that big run-up.
And the drops have been pretty substantial already. S&P 500 down 16% from the February high.
And that index of the Magnificent Seven tech stocks, down almost 30%. That's definitely correction territory.
Ouch.
Yeah.
Yeah. And now earnings season adds more uncertainty. People aren't just watching the numbers, they're really watching the guidance. What are these companies saying about the future, given all this trade turbulence? Tesla reported after the close yesterday, right? Everyone's watching that one closely.
For sure. It's seen as a potential early indicator.
Interesting point in the article. Even though Magnificent Seven valuations have come down a bit, trading at 22 times forward earnings versus a long-term average of 28.
The dip buyers still haven't really jumped back in.
And they give the NVIDIA example. U.S. authorities blocking sales of that H20 chip to China. That's a direct hit from trade policy.
Absolutely. A very concrete example of how geopolitics directly impacts these tech giants. But the article also points out this really low call-to-put ratio. Sometimes that's a contrarian signal.
Meaning when everyone's super pessimistic, maybe the bottom is near.
It can be, yeah. They mentioned a similar low ratio back in November 2023, and that was followed by a pretty strong market rally.
So maybe extreme pessimism is actually a buy signal. Always tricky to call.
Very tricky. But then you have that quote from Daniel Kirsch of Piper Sandler. Pretty stark.
The one about treasuries, equities, the dollar, all selling off.
Yeah. It's all telling you the same thing. People don't want to invest in the U.S. That paints a pretty concerning picture.
It really does. And it leads us right into our next big theme. Tariffs and trade wars. The impact seems everywhere.
It really does. We're seeing it across several reports.
Okay, let's start with eBay. MarketWatch had this. Elevated tariff risks lead Bernstein to downgrade this e-commerce giant.
Yeah, Bernstein moved eBay to neutral. Why? The unpredictable environment from tariff uncertainty, especially hitting goods sourced from China, which is, a lot of what's sold on eBay.
So it messes with their pricing, their supply chains, everything.
Yeah, exactly. Makes planning a nightmare. Bernstein cut their price target too. They actually think eBay might be better positioned than some competitors, but the overall uncertainty is just too high. They're worried about GMV, gross merchandise volume, in the next earnings.
Okay, so individual company impact,
Yeah.
but then there's the broader economy. Another MarketWatch piece. Fed could be forced into steep rate cuts if U.S. economy is a casualty of trade wars, Citi says.
Yeah, Citi's got a pretty pessimistic view here. They think the U.S. economy could show real weakness by June, mainly because of trade wars. And if that happens, they think the Fed might have to cut rates maybe up to 5 times this year.
5 cuts. Wow. That's aggressive.
It is. They argue these widespread tariffs, the potential 10% universal one, plus higher duties on China, will really start to bite economic activity soon. They're watching S&P Global surveys for early signs, expecting unemployment to tick up.
But wait, aren't tariffs potentially inflationary? How does the Fed handle that? Cutting rates while inflation might be pushed up by tariffs?
That's the dilemma. It's a terrible spot for the Fed. Do you support the weakening economy or fight tariff-fueled inflation? A real bind.
Yikes. Okay, then we have direct tariffs. The Wall Street Journal reported U.S. slaps steep tariffs on Southeast Asian solar imports. Steep is right up to 3,500%.
Yeah, massive tariffs on solar cells from Cambodia, Thailand, Vietnam, Malaysia. The clear target seems to be Chinese producers shipping through those countries to get around existing U.S. tariffs on China directly.
So, trying to close a loophole.
Looks like it. The WSJ notes concern that China's using its global factory network to dodge duties. These tariffs are a big escalation.
But doesn't this hurt U.S. solar projects? Make them more expensive, even if the goal is renewables.
Absolutely. It seems counterintuitive, right? Trade policy potentially hindering clean energy goals by raising costs significantly.
Okay, one more on tariffs. Intel. MarketWatch had a piece saying Intel's earnings outlook could be useless. Here's what matters instead. Why useless?
Basically, because nobody knows what Trump's tariff policies might look like for consumer electronics down the line. Even though PCs are exempt now, the analyst quoted in the piece says PC demand is at high risk from potential future tariffs.
So much uncertainty about tariffs on gadgets means Intel's forecast isn't very reliable.
Pretty much. The specifics are totally unknown, so the guidance might not mean much. The focus, according to the article, is shifting more towards their Foundry Day event for a clearer long-term picture.
Okay, so from e-commerce to the macroeconomy, solar, tech hardware, tariffs are casting a really long shadow.
A very long shadow. And that's driving some interesting moves in global markets as investors react.
People looking for safety.
Exactly. Like German bonds. Bloomberg reported German 2-year bonds rally as buyers look for haven in Europe. Short-term German debt saw prices jump, Yields fall. Why? Investors see Europe as maybe more stable right now, given the U.S. policy noise, especially the Fed comments.
So a flight to perceived safety in European bonds.
Seems like it. The article even mentions some European investors supposedly bringing money back home from the U.S. because of tariff worries and anti-globalization trends.
And then there's gold. Wow. Bloomberg. Gold hits $3,500 as Trump's Fed broadside sparks flight to haven. $3,500 an ounce.
Unprecedented levels. The article directly links it to those worries about Trump potentially firing Powell, sparking this flight from U.S. assets.
It's been on a tear all year, hasn't it?
Oh, yeah. Up about a third in 2025 so far, according to the piece. It's trade tensions, eroding trust in the dollar, all feeding into it. Liliang Lei from Callanish Index Services called it a shift from the 2017 Trump trade to more of a sell America feeling.
Even Goldman Sachs is bullish on gold now.
They are. Now, technically, gold might be looking a bit overbought short-term, the article notes that, but the underlying demand for safe havens, clearly very strong right now.
And it's not just gold. The Japanese yen is strengthening too. Two Bloomberg headlines caught my eye. CDC's Japan trade deal with 120 target for the yen, and yen extends gains to break psychological level of 140 per dollar.
Yeah, the yen broke 140 against the dollar. Investors are looking for alternatives to the greenback, given all the U.S.-centric risks.
And Citi thinks it could go to 120. Why?
Their thinking, outlined in the article, is tied to upcoming U.S.-Japan trade talks. They expect maybe a deal, or at least the U.S. holding off on new tariffs against Japan. That stability would be good for the yen.
Less trade friction potentially helps the yen.
Right. Plus, the article mentions speculative traders are apparently record bullish on the yen right now. Lots of conviction it will keep rising against the dollar.
It's really something seeing gold and the yen, these traditional safe havens, doing so well because of all this uncertainty.
It tells you a lot about the current mood.
Bloomberg's general market update, stock market today, kind of reflected that mixed picture, right? U.S. futures bounced a bit, but worries remain.
Exactly. A bit of a rebound, but fragile. The yen stood out. China let the yuan weaken a bit. Gold hit records. And even trade talks themselves are making news. U.S.-India talks moving forward. U.S.-Thailand delayed. It's all part of this complex global picture. That yuan move, by the way, letting it weaken, could be China trying to offset potential tariff impacts on their exports.
Interesting angle. Now, shifting away from traditional assets slightly, Bitcoin. MarketWatch suggests Bitcoin could rise back toward $100,000 if this happens. What's the if?
The if seems to be a combination of technicals and macro factors, according to the article. Technically, if Bitcoin breaks decisively above $88,000, that could trigger more buying. Macro-wise, if the dollar keeps weakening, stocks fall, and gold keeps rising, that scenario could boost Bitcoin's appeal as an alternative store of value.
So the digital gold narrative potentially strengthening.
That seems to be the idea. The article notes Bitcoin has recently held up better than U.S. stocks, suggesting maybe it is acting more like a safe haven for some. They also mention some technical analysis breaking a downtrend line, bullish RSI divergence pointing towards potential upside.
So if the Sell America theme continues, Bitcoin might benefit alongside gold. Fascinating potential dynamic. Still debated, obviously.
Highly debated, yes.
Yeah.
But it shows how the narrative around Bitcoin keeps evolving within the larger financial world. The divergence from stocks is definitely worth watching.
Okay, changing lanes completely. Some potentially good news for biotech. The Wall Street Journal reported Trump's FDA sends a bullish signal to biotech. What's the signal?
It seems to stem from the new FDA Commissioner Marty Mccari. His comments suggest a more biotech-friendly approach. The WSJ article highlights his signals about potentially faster approvals for rare disease drugs, less reliance on animal testing, and just generally supporting innovation.
That sounds like a shift from some earlier fears the industry had, right?
Yeah, exactly. There was some nervousness about HHS Secretary Robert F. Kennedy Jr.'s views, particularly on vaccines. Mccari's tone seems quite different.
So even with potential FDA staffing issues, the market sees this as a positive sign for biotech, especially riskier companies.
That appears to be the reaction, yes. A dose of optimism in the sector, driven by perceived regulatory tailwinds, even amidst broader market gloom.
All right, now let's look east. A potential issue brewing in China's pension system. MarketWatch headline: Running on empty. Inside China's quiet pension funding crisis. Sounds serious.
It does sound concerning. The article lays out how China's pension system is facing a cash flow deficit. Payouts are exceeding contributions for the first time since 2018. It's partly demographics, aging population, but also a big chunk of workers in the flexible economy, like gig workers, are opting out of the state pension.
How many are opting out?
The article cited surveys suggesting over 40% of those flexible workers aren't participating. That's a big hole.
And the government's response? Raising retirement age, subsidies, is it enough?
Well, the Market Watch piece raises doubts about the long-term sufficiency. These measures might just mask deeper structural problems. There are risks of rising government debt or pension costs crowding out other important spending like infrastructure or tech investment. And there's a capital markets angle, too. The National Pension Fund Manager is apparently now a net seller of assets because local provinces need the cash to cover shortfalls.
So a major buyer turning into a seller. That could ripple through their markets.
It certainly could impact market stability and investor confidence there, yes.
Okay, finally, let's touch on Tesla. Earnings were huge news this week. MarketWatch had articles like, Tesla earnings could offer hope for the stock, but this has to happen first. What needed to happen?
Well, the outlook for Tesla was pretty murky going into the report, as the articles noted. Investors really wanted reassurance on sales, deliveries, and especially specifics on future stuff, the cheaper EV, robo-taxes. When are they actually coming?
Because sales had slowed, the stock was down big time, year to date.
Right. A lot of pressure on Elon Musk to deliver a turnaround story on the earnings call, basically. Give investors some concrete hope.
There was even chatter about Musk's Dogecoin tweets may be hurting the brand.
That was mentioned, yeah. Though the bigger concerns were really about core demand and future growth. While Tesla might be less directly hit by some tariffs because of U.S. production, broader economic weakness or weak consumer spending could still hurt them.
So the cheaper model is seen as key to reigniting growth.
It's definitely seen as critical, yes. Successfully launching that could really change the narrative. The market was looking for clarity on that and on their path back to faster growth.
Okay, so wrapping this all up.
Yeah.
It's a really tangled web, isn't it? We've got the dollar bouncing around on sentiment and policy worries.
Big tech feeling the heat from trade concerns and facing earnings scrutiny.
Gold and the yen acting as clear safe havens.
And tariffs just impacting seemingly everything, from e-commerce to solar panels to the Fed's decisions.
Understanding how these pieces connect, dollar weakness, trade friction, tech pressure, haven flows, it seems really crucial right now.
Absolutely. These forces are feeding off each other, creating this complex landscape. The potential for ongoing dollar issues, the tech headwinds, the trade fallout, they're all key parts of the puzzle.
Which leads us to a final thought for you, our listeners. With all these challenges to the traditional financial order, doubts about the dollar's long-term dominance, the rise of protectionism, the appeal of alternative assets, what emerging trends or maybe assets we aren't even focused on yet might eventually challenge the dollar or really reshape how we think about investing in the long run? Something to mull over.
Definitely food for thought. It raises big questions about the future shape of the global financial system.
We'll see you all tomorrow morning with new headlines from major financial magazines.